Today, we're going to review the lineup of investment-oriented sessions that we've planned for the CCA Annual Meeting in October. The overall objective of our group in planning these sessions is to provide pension actuaries with opportunities to raise their comfort level with regard to capital markets, investment returns, and the setting of investment return expectations. We look to provide sessions in each of three categories. The first are sessions focused on current issues in capital markets. The second set of sessions is focused on hands-on pension investing. And the third session is on a more general financial topic that may be capturing current attention. The first session is 209, interest rates, ? Things have changed dramatically with regard to capital markets and interest rates. A 40-year downward trend in rates has clearly ended, and it's unlikely to return for a number of reasons, one of which is shifting demographics. That means proportionally fewer retirement savers than we've had in the past. The Federal Reserve raised rates dramatically starting in early 2022 to combat surging inflation. That effort has mostly succeeded. So now what? What are the supply-demand drivers that will determine the level of rates going forward? Given those drivers, what is the natural level of rates absent Federal Reserve intervention? Second session is 509, FE and LDI, lessons learned after 20 years. Financial economics started capturing actuaries, plan sponsors, and, for better or worse, regulators' attention more than 20 years ago. Liabilities had grown large, plans were maturing, regulation was increasingly focused on market value measurements, and plan sponsors were becoming more concerned about short-term risk. FE approaches developed back then have continuously evolved. Some of the evolution, admittedly, was maybe more about marketing, developing new labels for the same old stuff. But now, there's more focus than there was on winding down, outsourcing, and terminating plans. This environment brings an array of new challenges, and our presenters will talk about how these new challenges are being met. The third session, the one focused on general interest topic, is Social Security, what went wrong? Obviously, Social Security is increasingly in the media these days, and we'll be talking about it from a financial perspective. Projecting and planning for a society-wide pension program like Social Security is very different from the typical pension financial exercise. Here we're talking about an open group valuation, a program that is funded mostly on a pay-as-you-go basis, and valuations incorporating society-wide demographic and financial trends and experience. The baby boom generation tested this funding scheme through its historically large size, which threw kind of a monkey wrench into the system's financial dynamic. Reform architects back in 1983 figured they had solved the baby boom issue by raising the taxes the boomers would pay while they were working, and then raising the retirement age at which they would ultimately collect benefits when they retired. But their scheme didn't quite work. A trust fund they projected will last until 2063, which, if you do the math, is after the baby boomers are pretty much out of the picture, is now looking to be depleted almost 30 years earlier. What went wrong? What can we learn from it? Maybe there are lessons here that can inform any type of long-term retirement planning exercise. So that's our array of investment track sessions for the October 2024 annual meeting. Hopefully, one or more of them will engage your interest, and we'll be seeing you in one of our meeting rooms in sunny Florida.